Well, a new survey of leading economic forecasters, the NABE, expects the pace of US growth to accelerate more than originally predicted over the next year. The panel of economists raised its GDP outlook 1 percentage point to 3.1%, while upping its 2011 growth forecast to 3.2%. But what's the long-term cost of all that public borrowing to get us where we are now? Are the federal and state deficits getting so out of control that America is rapidly becoming the next Greece? Or alternatively, are the forces of deflation so great that unless Washington pump primes and pump primes again, we could be the next Japan? Peter Schiff is the president of Euro-Pacific Capital, also running for a Senate seat in the state of Connecticut. And Mike Musa is a senior fellow at the Peterson Institute for International Economics and a former chief economist for the International Monetary Fund. Gentlemen, welcome to you both. Thank you for joining us. Peter, if you had to choose, which are we closer to, Greece or Japan?
Well, man, out of Greece, Argentina, Zimbabwe, I mean, we're nowhere near Japan. I mean, we're not going to get off that easy. See, when Japan started making its mistakes, it did it with a position of strength. The Japanese had significant domestic savings. They had huge trade surpluses and current account surpluses. We're at the opposite situation. We've exhausted our domestic savings. We have a huge trade deficit. We can only borrow money if the Japanese and the Chinese and the Saudis lend it to us.
But importantly, we have inflation at 40-year lows, and we have a very high rate of underemployment or employment.
The Fed's balance sheet has grown by 150% in the last 2 years. That is massive inflation. The fact of the matter is that prices should be falling in the United States. They're not. They're rising instead, despite that, because of all the inflation that's been created by the central banks. And, you know, when foreigners wise up, when they stop buying our bonds, you know, then you're going to really start to see a collapse in the value of the dollar, and prices are going to be going through the roof. And that's also going to send interest rates up, and that's going to really exacerbate the ability of the U.S. government to pay the debt, because we've got it all financed with Treasury bills. But when interest rates go up, it's impossible for us to pay off the debt without printing even more money.
Mike Musa, do you see that?
No, I think we're about 6,000 miles from Japan and about 6,000 miles from Greece. Our situation is not in any way comparable to either one.
Why do you say that? Explain.
Well, we are growing much more rapidly than Japan. Japan grew 1% in the 90s, grown 0.5% this decade. We grew 3.5% in the 90s. Even with the deep recession, we grew 2% in this decade. So we're much stronger there. And as far as Greece is concerned, we have a record of fiscal probity, having brought our debt to GDP ratio down several times in the post-war period.
Yeah, you know, first of all, we're not actually growing. Our economy isn't growing. The GDP is going up because we're spending borrowed money. But all we're doing is spending more. It's not our economic output that's increasing. Meanwhile, our debts are rising. It most certainly is
our economic output that's increasing.
No,
we're growing, as the NABE suggested, 3% this year. I think probably 4%.
Yeah,
and we will have a relatively normal cyclical recovery. To say otherwise is just a lot of nonsense.
No, it's not nonsense.
Yes, it is. Absolutely.
No, the government is spending money. Consumers are spending money. It's not economic growth. We're destroying our wealth. We're going into debt. The debt is rising much, much faster than these phony GDP numbers.
The GDP numbers are not phony. You're just speaking a lot of nonsense.
No, I'm not. I mean,
yes,
that's
you
what
are.
People...
Absolutely.
No, look, I don't speak nonsense.
Yes, you certainly do. You say that our gross domestic product is not growing. Because you just don't know what you're talking about.
No, the GDP is growing because it's made up of government spending and consumer spending. But where are they getting the money to spend? We are borrowing
government
it.
And spending growth accounted for about 1/10 of GDP growth over the last 4 quarters.
Well, all this money that the government is spending, you don't think that's part of the GDP? It's a lot more than that.
Okay.
Real government purchases about 10%
the money that the consumers are spending, they're getting from the government.
Gentlemen, both arguments have serious implications for investors. Let's briefly bottom line what you're saying and what the takeaway should be for people who are trying to preserve their wealth. Mike, how would you advise people to invest?
Well, I think the basic rule is remain well diversified among stocks, across stocks and bonds and other assets as well. The American economy, I think, still has a bright future ahead of it. But there are risks, and the market will have its ups and downs, as we've already seen this year. But I think it is fundamentally quite strong.
Peter, how would you tell people to preserve their wealth?
Well, in order to preserve their wealth, they need to get it out of U.S. dollars. Otherwise, it's going to be debased. So you have to invest abroad. You have to invest in inflation hedges like gold and silver, like commodities. You have to look to get income streams coming from currencies that are not the U.S. dollar. I'd avoid the euro as well. But you want to try to have currencies where the governments aren't going to have to print so much money to inflate their way out of debt, because ultimately it's the saver, it's the investor that gets left holding the bag for all the bailouts and all the stimulus.
Gentlemen, thank you both. Peter Schiff and Mike Musa, thank you very much.